Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Another week's gone by. It's that time again. We're here to talk about real money, real life. That's Tom Cock over there, and I'm Don McDonald, and this is our special Talking Real Money Christmas extravaganza.
And what is so special about this extravaganza?
Well, it's just like every other extravaganza.
All right,
every single week that we do the show, it's an extravaganza of extraordinary information related to how you deal with money and how you can get the best gift of all, a great future by dealing with money better.
Are there no mutual funds?
Well, there are,
Yes,
but not all of them are good.
Yes.
And we will talk about that.
Good Lord.
And you are invited to talk with us about it. I'm Don, that's Tom, and our phone number here is 877-397-5666. 877-397-5666. And if it is a problem you face with a buck or two, or you have a question, or you want to get out of some trouble you got into, or you want to avoid trouble, give us a call, 877-397-5666. And Tom, what a wacky month so far.
You know, at this week.
This is a wacky month,
But here's one of the things I love. I just got back from a couple of days of a little R&R, as you know, back in the other side of the state, waiting for the snow to fall, which never did. But so I get a chance to watch some of the, the weird shows, because my wife and daughter sleep in a little bit, so I get up and watch some of the stuff that I never watch.
Yeah, because you get up at like 3 in the morning.
And everybody sleeps. I love this stuff. So they had a guy on this morning who said, oh, yeah, 2015, market up about 10%, but it'll be wild. It'll be unpredictable. Really?
It'll go up and down.
Really? Well, go out on a limb there, why don't you? Because if you go back about 100 years, the market kind of goes up about 10% a year, and it's pretty much wacky and wild along the way.
Yeah, but this last week was true. I mean, suddenly, after all of the experts back in November, they had this big oil meet. They all got together and talked about oil prices, and only 5% of the people at this meeting thought that oil prices would go down. That tells you how bad the experts are.
That means 95% said it would go up?
95% say they'd stay the same or go up.
Wow.
Whoa, were they wrong?
Yeah. So,
gas at $2.50 a gallon?
And so
who thought?
Who thought? So here's what some of the things people were asking us about this week. One was, of course, Russia, which, as you know, the ruble is now, I get all kinds of varying numbers, but it's somewhere between 60% less value
60,
compared to the dollar than it was
like
at the beginning of the year. I mean, it's way down from where it was. So
no, I mean, it's like 60 rubles to. I don't know.
Well, I think it's 50% off. Whatever it is, and it had a very difficult couple of days there in the middle of the week before, I guess, Friday it made a rebound. But here's what people wanted to know: how much Russia do I own in my portfolio? Because we tell you to be globally diversified, right, all throughout the globe, and yes, some of that money is traded in Russia and in rubles, and so people worry about how much of this do I own. Well, we ran the number.
We did. We actually ran the numbers on our portfolios. And by the way, folks, of all of the emerging markets out there, Russia makes up only about 4%.
Yeah, it's not a big deal.
It's not a big chunk of the emerging. And it's considered an emerging market, by the way, despite the fact that it's ginormous.
Yeah.
It's an economy based on pretty much two things: oil and vodka,
and the anger of Vladimir Putin. Three things comes in handy the holiday season. But so how much in our portfolios? Well, we ran the numbers. If you're 100% in stocks, it's about 0.2% of 1%.
Less than 0.2.
0.2. We'll just say for sake of rounding, 0.2. So it's not a big deal when the bottom falls out. Shouldn't be a big deal in your portfolio, but in some emerging market funds, I think you said the average in an emerging market fund is about 4%. 4% of the portfolio is in there. That's a lot.
And there are some that have taken that last year took some huge bets because they thought, you see, this is one of the problems with trying to predict the future. They thought that economies like Russia and Mexico and Brazil would be really, really hot. They thought they were wrong. So they made big bets in those economies, and they got really badly burned, as did their investors.
Yeah, so it was a wild week, and at the end of the whole week, the index we think you should pay attention to, the Dow Jones World Index, up 2.6%. So
the world went up,
yeah,
Tom.
The world went up, as it kind of does over the long haul.
It wasn't the end of the world. The world actually rose. 877-397-5666.
Well, I got a 4-year-old and a 2-year-old, and I want to start some kind of savings for them to go to college. And I'm still undecisive or whether get the GET here in Washington or go with the 529 plan.
Oh, go 529. Go 529.
Here's a way to look at it. The GET program, it's more conservative. Mm-hmm. Okay, so if you're not at all a risk taker, then you might want to go with the GET. But over the long haul, the 529 has provided more money for people that are willing to take a little bit of risk by putting the money in the market.
Plus, there's more flexibility with a 529. You don't know what your kids are going to want or be like in 14 to
Sound like they're
16
having fun
years. And so, the 529 can be used for all kinds of things in schools all over the country, even trade schools, whereas a specific state plan has to generally be used within that state's educational system, and that can be a very limiting factor for a kid who's a brilliant scientist and wants to go to MIT and get some sort of a deal to go to MIT. You don't want to limit them. And also, the potential for a 529 is so much greater given the amount of time you have.
I think they're liking the answer, Don.
And I would go to the Utah 529 plan because it offers Vanguard and Dimensional funds. You can set up these age-based programs. The costs are incredibly low, and it's just really easy to do, too.
You can go, I think you can just type in Utah 529, right? Find it online?
Yeah, just type it in Google, Utah 529.
Like the state.
Even though I live here in Washington, I can still be on the Utah program.
Oh, that's a great question.
Absolutely.
Yeah, yes, that is one of the things people have had a hard time understanding since these state programs have been around for 15, 20 years, something. Anyway, at any rate, yes, you could live here and use the West Virginia plan, which is another one that we have recommended as well. So, yes, that has no impact.
My wife just had a last question.
Yes.
How much is the risk? Like, is there any risk of losing it all at any point?
Losing it all? Only if we get hit by an asteroid. Short of getting hit by an asteroid, you cannot possibly lose it all. You really can't. The entire economy of the world would have to collapse because when you use the Dimensional and the Vanguard funds, you're getting massive diversification. And what they do with those age-based programs, Net, is they start out more heavily invested in stocks, and as the child gets older, the fund becomes more conservative.
So as they start to use the money, you're less in stocks, more in bonds, so that there's less
volatility.
Yeah, you're moving up and down less in the account. So I think, no, you can't lose all the money unless the world's economies go.
And if that happens, you won't care where your kids' money is. You won't care.
Be another set of priorities at that point.
Yeah, that would be right. Okay, well, thank you very much, and thank you for taking my call.
He raises his wife raised an interesting point, this point about risk. Our fear as investors typically is that because we're not thinking about investing as investing, we're thinking about investing as gambling. And that they're not synonymous. Investing is not buying a single stock and then hoping it goes up and it doesn't go out of business.
Or it goes the other direction and goes away.
Real investing is buying the economy, is buying a segment of the economy, is building a portfolio for your risk tolerance and your age in this case. And there is, if you're diversified, there is no chance. And I sound a little flippant when I say there's no chance except an asteroid strike, but I want everybody to think about this for a minute. Think back to the last 100 years on this planet. There have been 2 giant global disasters, also called world wars, that destroyed entire nations, and yet the economy of today is more valuable than it was in 1914 or 1944 or 1974. So it's bound to grow. It has in the past. It probably will in the future. And if it doesn't, you have bigger fish to fry, or you hope you have some fish to fry.
Tom and Don are talking real money.
The holidays are upon us, and that means 2015 can't be far behind.
Seriously? Wasn't it just summer?
When you get as old as you, Don, time flies. That's why we all need to stop procrastinating and start planning for the future.
You know, Tom, that's a darn good idea, because the future and retirement seem to be approaching faster every year.
The best way to enjoy a really great retirement is by starting your financial plan, and the first step is creating a future blueprint.
Yep, that's why we created My Future Blueprint at myfutureblueprint.com. A personalized, detailed report on your current investment portfolio and where it might take you in the future.
Discover the true diversification of your portfolio, what you're really paying, and whether or not you're on track for the future. And it's the end of the year. It's totally free at myfutureblueprint.com.
Creating these is such a time-consuming process that we can't afford to keep giving them away. So starting in 2015, My Future Blueprint will cost $199. So get one while it's free.
Get yours now at myfutureblueprint.com.
For your real life and real future, Tom and Don are talking real money.
Talking Real Money continues. It's your life and your dough. 877-397-5666. Saturdays at noon Pacific, 3 p.m. Eastern. Jim, you're next. Welcome to Talking Real Money.
Hey, here's what I've got. It's just a 2-year-old and a 4-year-old. My wife and I are 60. Where she's going to retire really quickly, and I'm going to kind of reallocate my retirement money now. And here's what somebody said to me. Well, have you outperformed the S&P 500 every year? And I said, no. He said, well, why don't decide how much you want to go into bonds, and then go with an S&P 500 ETF or something, and put some in Berkshire Hathaway. So my first question is, do you like that plan?
No,
we don't like that plan.
No, I hate that plan.
Uh-oh.
Okay.
I thought we lost
my
it.
other question too. Then,
No,
okay?
we didn't lose him.
The other question is with my bond portion. Do you like picking individual bonds? I hear different people are going back to.
How much money? How much are we talking about, Jim? How much money?
It doesn't really matter, but let's say $1 million.
Yeah,
Well, no,
it does.
that's
It does.
huge difference.
If you have $100 million, buy individual bonds. If you have $1 million, no.
Okay.
And let's explain why.
Please do.
Okay.
Part one is it's a very expensive way to operate. If you look at what the action, by the way, people buy bonds and think they're not paying anybody. No, they're paying a huge amount.
Huge amount.
You just don't see it. It's not transparent, so it's expensive. Number two, buying an individual bond is just like buying an individual stock. You have the risk of that entity. You have the risk of, in a case of a stock, of that company. When you instead own a bond fund, you own hundreds, thousands of securities. And so when the state of California, whatever, can't meet its obligations, that doesn't matter because you have another, 3,000 securities around the country that are still being able to pay their obligations, okay? So for those reasons, I mean, Don, you got something more, but those are the ones.
No, well, those are a couple of great ones. I mean, government bonds you buy cheap, but the only time I would buy individual government bonds is if I was building a bond ladder.
Yeah, that's a different thing. Yeah.
A bond ladder makes a lot of sense to me. But going out and buying individual bonds is a lot more work, and it can be, particularly with corporates and municipals, can be very, very expensive. And by the way, just to go back to the Berkshire Hathaway deal, Berkshire Hathaway is so risky because it is just a few businesses, really.
How many? I forget. Yes.
I don't even know.
I mean, and the guy who runs it, I forget his name, Warren something. He basically said you should just own the S&P 500,
which we think is a bad idea.
Yeah,
too.
I mean, well, that's part of the portfolio, but you want to own more. Here's what greater diversification than the S&P 500 has meant. Okay? It has meant less volatility because you own more things instead of fewer things. It has to, in a way, right? Because it's less risky to own more of something than it is less. And by the way, by owning more small companies and more value companies, international, emerging markets we mentioned earlier, that has meant greater returns over time as well. So it's meant greater money, lower volatility because not everything goes up and down together, and that's why.
Actually is lower risk because you don't have any chance of all of those stocks that if you own the whole planet, there is no chance for every single stock you own to go under. Now, there is the possibility, albeit slight, that all the stocks that Warren Buffett owns could get into trouble. That's possible. Not likely, but it is literally impossible for every single company on the planet to go broke simultaneously. And Tom keeps flashing pictures up there on the screen of Bill Gross in front of my face.
Bill Gross is known as what? We've said this before.
As scary.
Yeah.
Scary looking.
Well,
he looks like Skeletor or
yeah,
something.
he does. He's thin. He's thin.
He's gaunt.
Yeah, he left PIMCO 3 months ago.
The Grim Reaper.
3 months he's been gone. Went to some little mutual fund company back in Colorado.
Yeah.
Which is a state that people here don't. I mean, we don't pay a lot of attention to Colorado. Their football's not very good. The weather's poor. I mean, we don't really.
They got a pretty good NFL team.
Oh yeah, okay. At any rate, he left PIMCO Total Return, but before he left a great legacy, and that is he changed the prospectus that allows PIMCO now, the PIMCO Total Return Fund, which has seen $85 billion flow out of it this year. That's $85
Well, it's like
billion
somebody
with a B.
blew up the dam.
I mean, that's more money than most money managers see in a lifetime, and it's all left this one fund this year. It's remarkable. But here's the good news: for those of you who still own it and think you own kind of a middle of the road intermediate bond fund, Mr. Gross changed the prospectus. It now allows them to own more than 15% of the total fund in emerging markets, which you've been hearing about recently, right? Because there was a little problem in Russia this week. And some of those economies are kind of thin.
I did hear something about that.
Markets like Mexico, Brazil, they allows them to own more than 20% of the bond this is a bond portfolio in short-term bonds issued by those governments. They're called emerging markets bonds. They're kind of risky. And they own them in the local denomination. So when things like this week happened, when the Russian ruble took the big dive, guess what? Your portfolio headed south too. And so this is crazy. I mean, why would you own a bond fund that does that kind of thing? Bond should be the safe part of your portfolio, Don.
Well, and the other thing about this fund is, why would you own it at all? I don't understand it.
It's everywhere. It's in every 401k plan.
It's got a huge turnover, 227% turnover, ridiculous fees.
Yeah.
They have bonds of every type, shape, and color, and it's just a mess. It's a mess. It's not conservative. It's scary.
And by the way, here's my take, still saying same thing. It's being run by the marketing department because they need to keep some of that money in there. They're going to take more risk with that money because guess what? They need to look better than just the regular garden variety of bond fund. So
and
that
that's
they can
the
go
only
to public.
way to make more. That's the take more risk.
Yep.
You make more money, maybe.
Give us a call, 877-397-5666.
Colleen, you're next. Welcome to Talking Real Money.
Hi, thank you for taking my call. I wanted to know if you have any resources for non-need-based scholarships, websites or people that want to talk to know how to.
Well, they're gonna be different all over the country, and so your best bet. Yeah, but what I'm saying is you're going to find that they're different in every community. In my little community, I'm in a small town, and literally we just went asking around people who were in clubs and organizations. Put my daughter on the phone, my wife got on the phone. We just started asking these groups if they had scholarships. Started asking community organizations and clubs, and went through an educational association in our county that had some resources. We did talk to counselors. They did have some resources.
By the way, and because earlier somebody said the schools don't help you. I think that's wrong. The high schools now spend a lot of time laying out, here are all the scholarship opportunities, especially the local ones.
And if the high schools don't have it, the school district itself may have it.
And they usually have a foundation. And I'm, as I say, familiar with this because I'm involved with I have my own little scholarships I give out every year, and those go through a local high school, a local school foundation where they go out to the kids and they say, hey, you ought to apply for this. Here's the criteria, and here's how much money they're giving away. So I agree with that.
I would start with your school board. That's where I would actually start. Either start with the counselor or go to your school board and say, do you have an educational foundation that helps find scholarships? And most do.
Okay, that's terrific. Thank you.
Good luck. Thank you.
And that brings us to something else for the holiday, Don, and that is you can still do the Roth IRA gift. Oh, it doesn't sound very sexy. I mean, it's not as good as an Xbox for a young person.
Oh,
but, man, when you're gone in 40 years, they're going to think you're the greatest person ever. And now here, we talked about this last year. A Roth IRA grows tax-free when you take the money out, no taxes. There's nothing else like that in the world, folks. So if there's a young person in your life who has some earned income, they have to have earned income, They can put that amount of earned income away in a Roth IRA. Maybe they don't have the money anymore. Maybe they did buy the Xbox, but you have the money. You can go to TD Ameritrade, right, Don, and open
Correct.
up a Roth IRA.
It's a free account, by the way. It's a totally free account.
We haven't figured out how they make money on this.
There is no minimum. The only minimum is that you must buy at least one share of an ETF.
Yep.
So, but look at this. If you put $500 into something like a world index,
which is the
VT,
ETF?
the Vanguard World
VT, okay.
World ETF. You put that in for a 20-year-old right now.
Yeah.
And that's all you do for them. That's it. You do that. That's an Xbox with a couple of games. By the time they retire at 65, even at 8% a year, which is below what the VT or funds like it have done in the past, $18,000 from just that $500.
There you go.
I guarantee you that Xbox, even if it's in pristine condition, is not likely to sell for $18,000 45 years from now.
Good chance from there. So go get that done. Your shopping days are not over. You can go to TD Ameritrade, set up a Roth IRA, and buy the VT ETF. Get the young people started right down the road to success.
Tom and Don are talking real money.
For years, Vanguard has told you to invest on your own in low-cost index funds. So it might surprise you that a recent Vanguard study found that investors who use low-fee financial advisors make on average about 3% more per year than those who don't get professional help. Why? The study found that advisors help you create a better portfolio for your needs and risk profile, maintain the proper balance, and keep you from making emotional decisions. I'm Don McDonald from Talking Real Money, and my company, Vestory, is one of those advisors. We can help you develop a long-term financial plan, construct a risk-appropriate portfolio, deal with the ups and downs of the market, and create a livable income in retirement. We use low-cost index-style mutual funds and never try to time the market. And we're required to act in your best interest. Let us help you build a better future. Just go to TalkingRealMoney.com or call 800-386-3004. Build a great retirement with the right portfolio, an advisor that acts as your fiduciary with low fees and low minimums. Find out more at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Your life, your money, and all the things you do with it here on the show. And remember, you can call us on Saturdays at 3 p.m. Eastern, noon Pacific at 877-397-5666. Or you can send in questions online at our website, talkingrealmoney.com. And Tom, one of the questions that comes up this time of year, a lot of people are wondering, is there anything I can do? We've got less than 2 weeks left. Is there anything I can do to improve my tax situation next year?
The answer is yes.
And there is still time.
There's still time.
But you got to have some losses.
Yeah, well,
That's
no, but here's you can still do, and you should, if it's on your list, charitable contribution. So I just wrote a check to a charity that's near and dear to my heart. I also have a pickup scheduled at my house for the day after Christmas. We're giving away a lot of stuff to charity.
All the Christmas presents are going out to the truck.
There's my nickname. But there's lots of, and by the way, here's another one. You can defer income. So in my case, we have some money from another business. We're not going to take that until 2015. Because then you can push that off to the next tax year, correct?
Right. And then there's tax loss selling.
Yeah.
If you have securities this works well with ETFs and with indexed style mutual funds. Because if you have a segment of your portfolio, and some of you do, where you'll have some European assets or something that are Asian assets, emerging markets assets,
international small,
where the value is down, you need a write-off. You don't even have to have capital gains to take some of this off of your taxes. You can deduct up to $3,000 against ordinary income. So you could take a $3,000 tax loss, then immediately find a similar ETF or mutual fund, preferably with little or no transaction fee, and move that money into that similar product as long as it's not identical, and park it there for 31 days and then move it back into the fund that lost money and take that $3,000 deduction.
It's overlooked. Tax loss harvesting.
harvesting. But you cannot take more than $3,000 unless you also have realized capital gains. It's dollar for dollar, though, against realized capital gains. So if you have a $10,000 loss and you have $7,000 in capital gains, then that entire loss becomes, in essence, deductible. You can offset the capital gains and then use $3,000 against ordinary income. In the other case, though, let's say you had a $10,000 loss that you took and you had no capital gains. That loss can carry forward over the subsequent years. So you can use $3,000 this year, $3,000 next year, $3,000 a year after, et cetera.
I want to mention one other thing that comes up a lot is the 401k. You can only make contributions for 2014 in 2014, but in a Roth IRA or IRA, you can make those until April of next year, April 14th of 2015, that are still 2014 contributions.
Right. But a couple of things to be aware of with IRAs. A lot of people get these confused. If you want a tax deduction, you would use a regular IRA.
Yes.
That will get you a deduction, but when you take the money out, it will be taxed as ordinary income. If you want the money to be tax-free at retirement, and we think this is a huge advantage to people who are young particularly, then you fund a Roth IRA. A Roth IRA, you will have to determine, if you're older and you're in a higher tax bracket, you will need to sit down and determine and guess, really, which is more advantageous to you, whether it's better for you to take the tax deduction and pay taxes down the road. And it may be that that's the case. If you're in your 50s and you're at your highest earning years, you're at a huge bracket, you may want to take the deduction if you're eligible and then wait when you take the money out and hope that you have a lower tax bracket at that point. So you do have to do some calculating to determine that, but you need to know the difference. Roth IRAs, no deduction. Regular IRAs, an immediate deduction in this tax year. And
we mentioned earlier, still time to do that great Christmas gift for a young person. That is setting up the Roth IRA. And as Don pointed out, you can go to TD Ameritrade. You can open a Roth IRA for someone there.
No minimum.
No minimum. And you can buy the VT.
No fees.
VT. V is in Victory, T is in Tom. That's
no
an ETF.
Transaction
It's crazy.
fees.
I'd love to know.
I don't know how they make money.
Yeah, I'd love to know where the profit for them is on this. But you can open that up, and away you go. You can put up whatever they earn, whatever that person earned this year. You can put up to that amount in the Roth IRA with the cap at, I always forget the
$5,500.
$5,500. And over 60, over 50, it's $6,500.
Exactly. Yeah, that's correct. And we're coming up on the end of another segment, but fund those IRAs or Roth IRAs. It's going to require a little predictive capability. You're going to be in a higher tax bracket in the future than you are now. If you're going to be in a higher tax, if you think you'll be in a higher tax bracket in the future than you are now, then a Roth makes more sense. If you're higher now than you might be in the future, then a regular makes more sense. It's still a guessing game. And we're going to help you guess. All you have to do is call. Saturdays, 3 p.m. Eastern, noon Pacific, 877-397-5666.
Talking real money.
The holidays are upon us, and that means 2015 can't be far behind.
Seriously? Wasn't it just summer?
When you get as old as you, Don, time flies. That's why we all need to stop procrastinating and start planning for the future.
You know, Tom, that's a darn good idea because the future and retirement seem to be approaching faster every year.
The best way to enjoy a really great retirement is by starting your financial plan, and the first step is creating a future blueprint.
Yep, that's why we created My Future Blueprint at myfutureblueprint.com. A personalized, detailed report on your current investment portfolio and where it might take you in the future.
Discover the true diversification of your portfolio, what you're really paying, and whether or not you're on track for the future. And it's the end of the year. It's totally free at myfutureblueprint.com.
Creating these is such a time-consuming process that we can't afford to keep giving them away. So starting in 2015, My Future Blueprint will cost $199. So get one while it's free.
Get yours now at myfutureblueprint.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And you are invited to talk about it with us at 877-397-5666. That's 877-397-5666 on Saturdays at 3 p.m. Eastern Time, noon Pacific. Give us a call. It's pretty easy.
Ken, you're up. Welcome to Talking Real Money.
Hey, how are you guys doing today?
We're doing great. Merry Christmas. Thanks for being part of Talking Real Money. How can we help you?
Well, I wanted to ask, earlier you mentioned about the, being with someone like Edward Jones or something like that.
Yes.
And I currently have a 529 for each of my kids with Edward Jones and a Roth IRA for my wife. I'm going to be switching jobs, so I'm going to have a decent size 401k to switch over.
Don't give it to the Ed Jones guy.
So what's the? I guess I'm just wondering what do you?
Yeah. Great question. Well, we lost him too for some reason.
Oh.
I don't know what happened. Well, we switched anyway. So
something's going on with the phone line.
So let's go through the difference between hiring. If you're going to have somebody else do this for you, right. Okay, the difference between hiring somebody in the brokerage industry versus hiring a registered investment advisor. Go ahead.
And I wish he was still here because I'd like to ask him a few other questions, but. Here's my guess. I'm going to just guess, Ken. I'm going to guess that your accounts have funds from American Funds or Oppenheimer, Putnam maybe. All of those are fully loaded funds at 5.5% to 5.75%, and they tend to have very high expense ratios from about 0.75% to about 1.5% per year. That's expensive. That's a lot of your money going away.
We got Ken back, by the way.
Okay, Ken, are you there?
Yes, sir.
Sorry, we lost you.
And I heard
did you hear my guess about the funds?
I am an America Fund for both of the five.
How did I know?
Surprise. How about
Do you know that they get a kickback from American Funds for selling those to you? It's even in their prospectuses.
Does that come out of my investment though?
It comes out of some of the money you pay to American Funds. They kick back to Ed Jones, and plus you paid Ed Jones.
Commission.
You paid Ed Jones 5.75% to get into that.
What?
Seriously?
Say that again. Give us the comment when we told you that.
What?
What? Yeah, thank you. That's perfect. Okay,
yeah,
so here
5.75% of your money went to them.
Last week, who's one of the America's top experts on mutual funds, what did he say about hiring somebody who has a commissionable product? There is huge amount of risk anytime there's that conflict created by the person who wants to sell you something. So that is a problem. Number two, no one at Ed Jones is required to live up to a thing called the fiduciary standard. They're not required to put your interests ahead of their own, okay? Number three, even the funds, you mentioned American Funds. I don't know what the expense ratio, Don, the average.
American Funds expense ratios runs from about 0.7 to 0.9.
They're more expensive than owning index mutual funds, even if you go hire an advisor.
Index funds run from 0.5 to 0.05 to 0.5.
And here's the kicker. They actively managed funds over time have underproduced index funds over a very long, and so that's the problem we have with them.
And when you
do you have a list? If I'm, let's say I live in Bonnie Lake, do you have some source where it's someone you guys recommend to use?
We do, actually. If you go to talkingrealmoney.com and you go to the read section of talkingrealmoney.com, we have a list of advisors in the Seattle area that we think are fiduciaries who use scientific passive investing principles and who we have good confidence will do a good job for you. It's also something you can do on your own. These guys, you're making a living for the guy at Ed Jones. And that's okay as long as it's all disclosed. But apparently, there's a lot of stuff from your what comment. There are a lot of things that aren't being disclosed, and boy, he's going to be chomping at the bit when it's time to get his hands on that 401k because he's going to make some huge commissions. Heather, you're up next. Welcome to Talking Real Money.
Thank you.
What can we do for you, Heather? Hi, Heather.
Oh, sorry. Hi. So I just I was listening to you guys talk about Roth IRAs, and last year because everybody says you should. I was 39, so max out my Roth IRA, and so I did that in December, not knowing I had till April. And then this year I was going to do it again, and I logged into Fidelity because all my work stuff goes, my 401k and all that is through Fidelity, and they put it in a 2040. That's when I'm going to retire. Hopefully.
You did a target fund.
Yeah, a target fund. And so I logged in to I just went through Fidelity just because I'd have everything all kind of consolidated. And realized I made 56 cents last year because I didn't know that I had to tell them to put it into something. It was just
so
in
it's been sitting in cash. Yeah.
Oh,
Yeah,
you had
I
a
didn't know
money
that.
market. Oh.
Well, you know what? You're still
I didn't
young.
know that.
It's okay.
So, well, thankfully, yes. But so why hear you guys talk about, if you're young, Roth IRA is the way to go. But for the people like me who don't know anything about investing, not only do you have to put money in a Roth, but then you also have to put it into something.
Oh, that's a very good
Otherwise
point.
it sits in cash.
Well, and you make a great point, Heather. You know, we talk, and we're doing people a disservice by doing this to some extent. We talk a lot about doing this on your own,
Yeah.
but it's hard, right?
Confusing.
Yeah, I know. Yeah,
It's
so I didn't know
confusing.
what to do. So this year, when I realized I only made 56 cents, I said, "Cool, can we at least put it into my target fund? Because I don't know where to put it. I thought that the 401. I thought a Roth IRA was just a bunch of mutual. Like I don't know what I thought.
Yeah,
They put it
a
in
Roth
totally
IRA is
understand.
that is simply the vehicle that allows whatever you're invested in there to grow tax-free. Conversely, if you had it in a regular sort of a brokerage account, anything you did inside there would create a tax consequence. So that's simply the type
It's
of
just
account
the
you own.
bag.
Yeah.
It's the big bag in which you put your investments.
Can we get you to hang on? We'll take this up. We continue with this conversation here.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Welcome back to the holiday extravaganza version of Talking Real Money. We're here to help you deal with money
and avoid some problems along the way. And we're talking to Heather about putting her portfolio together with Fidelity. She left it money market. And Heather, I totally understand. People don't understand the difference between, the IRA account and the IRA investments. But let me just help you out a little bit. And now, let me ask you a question first, though. If at some point, now you understand that no one can predict the future, right?
Right.
Okay. Stock markets go up and down, right?
Sure.
They go up more than they go down. They always have. We don't know about the future, but if they go down more than they go up, then we go to zero and we have bigger problems than our investments because then the economy of the globe collapsed.
Mm-hmm.
So if 5 years from now, 2 years from now, 12 years from now, your investment portfolio in this Roth IRA dropped by 50% in just a year, would you panic and sell?
How old was it? When?
We don't know. Could be next year. Could be 5 years from now.
No, not next year or 5 years from now.
Okay, good. Because you're going to make it more conservative as you get older. When
Yeah.
you get older, you're going to make it more conservative. Here's what I would suggest you do. This is going to make your life really
You got a pen,
easy.
something to write down?
Instead of doing a target
I
fund,
got a pen, paper, I'm ready to go.
Oh, here we go.
instead of using a target fund, which just sort of arbitrarily decides when you should be where and doesn't give you the right asset allocation, in our opinion, start simple right now. You're going to learn more with time. As you listen to us, you're going to get better at this. But start now with two funds.
Two mutual funds in
Two
your
funds.
Roth IRA.
The first one is
Oh, in my
Fidelity.
Roth. This is just in my Roth.
This is
not
just
my
in your
401.
Roth. Yeah, we don't know what funds
We don't
are
know what's available in your 401.
You could
but
send
for
that
your
to us,
Roth,
yeah.
Use Fidelity Spartan Total Market Index Fund.
What is it? What's the ticker?
FSTMX.
FSTMX. So one half of the money goes in that
And this
fund.
is for both you and for Ken, who called with the Ed Jones account.
Oh, yeah,
the
that's
commission on that is 0, and the annual expense ratio is 0.1%.
Wow.
One
That's great.
tenth of 1%.
Cheap, cheap, cheap. Keep that money in your pocket.
Okay, so that's the-
FSTMX. FSTMX.
That's the first half of the portfolio. The other half of it will be in the Fidelity Spartan International Index.
So you're going to have 100% in stock. So it's going to be up and
50%
down a
U.S.,
lot.
50% international. That one is FSIIX.
FSIIX.
It is a no-load fund with a 0.2% expense
Cheap.
ratio.
Whoa, that's great.
You leave these alone for the next 20 years?
Yeah, it's a long time to be in an all
10
equity
years?
portfolio. Yeah, maybe at 50.
I don't know. You're not gonna. You'll know when you need to start becoming a little less risky. You start moving some of this money. You start taking some of the gains, and you put it into some very high quality, short, intermediate government bond funds with Fidelity. Done.
But for right now, you're in two mutual funds. So take every dime in that account. And by the way, if you're going to make a contribution,
The sooner you make it, the better.
no, put the money in and then buy these two funds. Does that make sense?
Yeah, well, I already put the money in, and,
okay.
I had them put in the 2040 like last week because I didn't want to.
Okay, so you're gonna sell the 2040.
Okay, they're going to do that, right?
You're gonna tell them to do this, and then you're gonna say put half of whatever all the proceeds, all the cash, everything, half in the one fund, FSTMX, half in FSIXX.
FSIIX. Tom's in trouble past two letters.
Okay, and then you're going to have that's a pretty good portfolio, actually, and very inexpensive.
Very inexpensive.
Yeah.
Okay.
So then my husband was going to he was going to max out his this year, start one. So I'll just have him do half his and same thing.
Same thing.
Why not? Yeah.
Yeah, why not? For now. As you learn more, you may want to diversify more as you grow this portfolio. You don't know, but keep listening and keep reading.
There you go.
You know, all these holidays right here around.
And Don mentioned something earlier that I think is worth repeating.
What?
You and your wife have agreed not to exchange gifts, which I think is very cool because it's cheaper. But if you're going to do a gift, this came up with my daughter. I said, just make me something. She's almost 30. So I don't do that art projects anymore. Still, I think those are the greatest gifts. And I said, then get a picture and frame it, something like that. Enjoy each other.
Check us out. You can read our newsletter at realinvestingjournal.com, or everything is at talkingrealmoney.com, talkingrealmoney.com.
For years, Vanguard has told you to invest on your own in low-cost index funds. So it might surprise you that a recent Vanguard study found that investors who use low-fee financial advisors make on average about 3% more per year than those who don't get professional help. Why? The study found that advisors help you create a better portfolio for your needs and risk profile, maintain the proper balance, and keep you from making emotional decisions. I'm Don McDonald, and my company Vestory is one of those advisors. We can help you develop a long-term financial plan, construct a risk-appropriate portfolio, deal with the ups and downs of the market, and create a livable income in retirement. We use low-cost index-style mutual funds and never try to time the market. And we're required to act in your best interest. Let us help you build a better future. Go to Vestory.com. That's Vestory.com. Build a great retirement with the right portfolio, an advisor that acts as your fiduciary with low fees and low minimums. Go to Vestory.com. That's Vestory.com.